to her. Thank you so much, Cheryl. The markets, meanwhile, experiencing record-breaking volatility last week. And while many experts blame the turmoil on China, some are pointing their fingers at ETFs, exchange-traded funds. Those wild swings that investors saw in what they expected to be safe havens for their money were in part caused by the way these funds are traded on Wall Street. We want to bring in Dritz Enterprises Chairman and CEO Mike Dritz and our own Dagen McDowell. Mike, good to see you.
Nice to see you,
Thanks so much
Maria.
for joining us. Explain what happened last week for exchange-traded funds.
Well, exchange-traded funds are equities. They trade like equities unless there is information on how they're going to open. They're bizarre. They don't then trade the way they should trade without any question. And this goes back to, if I can go through the history of the exchanges and how we got to this point. First, you had the stock exchanges themselves. And when you had the stock exchanges, you had the New York American Stock Exchange, followed then by the intermarket trading system, which started. Then you had online trading and then high-frequency trading. Let me go in order on those. First of all, the stock exchanges, you had a specialist system. Each specialist had approximately 100 stocks. They were responsible for everything that went on in those markets. Every single transaction was recorded. When it was recorded, they had the responsibility of a fair and open market, which meant that if they did not supply depth and liquidity to the marketplace, they wouldn't get more stocks. Essentially, they would go out of business. And during very difficult parts in the market themselves, they did go out of business because they were the buyers of last resort.
Right.
Now, then you started the intermarket trading system. What was that? Well, they said they had to have competition between the New York Stock and American Stock Exchange, the Chicago Stock Exchange, the Pacifico Stock Exchange.
Right.
And orders there had to be then transferred. An order came down to the New York Stock Exchange, and it wasn't the right order.
Yeah.
It would automatically get transferred to one of the other exchanges.
Right.
That was the beginning.
Okay.
Followed by online trading, where nobody had any responsibility for the market because it was just public orders or institutional orders that came in.
All right, so connect the dots on ETFs, Dagen.
What happened on Monday is you had some basically pricing problems with ETFs. These are multi-billion-dollar, supposed to be super safe. Yeah. They're mutual funds. They're not equities. They're mutual funds that trade like stocks. They're
not really mutual funds because the fees
funds
are much lower and they're much more transparent and tax efficient, which are different than mutual funds.
Right, but they also sold them. The ETF providers sell them as the tradability. That's one of the benefits over mutual funds. Well, these funds lost at the bottom 35, 45, 50% with many of the largest ETFs in the country. You had like a giant dividend ETF down 35%. Yep. The underlying, yes, there were problems with individual stocks. A lot of this related to the circuit breakers, the limit up, limit down rules that were put in place after the flash crash. It made it hard for people to price these things. The regulators are looking at this, the SEC looking at this now, looking at the market structure rules to prevent this from happening again. But I'll say this, that some of the people in the business that I talked to in the ETF business tried to put the blame on individual investors
that's the wrong thing.
using market orders and using stop orders that turned into market orders and said, oh, well, you should have known better than to trade them at the open. And I think that's maybe the wrong way to go.
This is Mike's, isn't this your main point? Don't use market orders if you're the little guy?
Absolutely. You can't use market orders and you shouldn't use stop orders. You can use stop limit orders.
Correct.
And then have the ability to adjust those limits. But a pure stop order, you don't know what it's going to get.
But I will argue that a lot of people were sold these exchange-traded funds thinking that they could trade out of them when it was in market volatility. Hey, I got this fund. I don't have to wait till 4 o'clock. It's not a regular mutual fund. I put it in order, and guess what? It didn't work the way that it was sold to you. And I will argue that if you've got an ETF and it's got low volatility in the name or minimum volatility and you lost 35 or 45% of your money Monday morning, you got a problem.
But by the way, I mean, the selling was really indiscriminate on Monday morning from individual stocks to ETFs. I mean, I was talking to one guy who trades only financials, and he mentioned KKR. KKR opened down 40%, okay? Yeah. So it closed Friday at 19. It opened at 10.
Yeah, and Mike, your point is that there's no specialist to be responsible for that.
Absolutely, because no one is responsible. What used to happen is before the opening, if you had a very big discrepancy, you wouldn't open it. You would put out a pure indication on the stock. And
they're not doing that with ETFs?
No. And the indication would show exactly a parameter. If the last sale was 40 and the indication is 25 to 30, people would rush in there and buy because it was too low.
Yeah.
It was way offline.
And look what happened to KKR.
To buy it down there.
After opening down 40%,
Exactly.
it's back to 19, Keith.
Yeah.
But
So,
I'll point out that one of the issues with these ETFs is you had an ETF that was down 35%, but the worst drop for any of the underlying stocks in the ETF was 21%, something like that. So there was even a disconnection between the underlying and the overall ETF price.
Well, so you don't blame the ETFs, though, bottom line. You're saying it's a lack of specialists. But I think that's an important distinction because so many people are saying the ETFs. You're not blaming the ETFs and the way they operate.
ETFs. What I'm blaming is the system. The regulators, for example, did not understand why the flash crash happened.
And they still
I have been an independent consultant
and the rules that
during that period when they did the Global Research Analyst Settlement from 2003 to 2008. So the people I worked with at the SEC, I called right after 15 minutes after the flash crash, and I said, do you know why this happened? I said, it happened very, very simply because when you have decided that orders have to go from one exchange to another exchange, and the New York had closed certain stocks at that point in time, all the high-frequency traders had pulled everything out. So if there were bids at 60 and the next best bid was 20 because there were no public orders there, it would sell at 20.
I have to point out that a lot of people in the ETF business privately who I talked to who sent me emails blame the investor. People in the media, some writers, Yahoo Finance writer, blame the investor, say you messed up, and I take issue with that because they didn't know it could ever happen.
Real quick, how worried are you about this sell-off?
I hate September.
You do?
I think September is always, to me, the worst
because
month.
Because you're a bull on stocks?
No, because September was always a difficult month for the market, period.
Right.
So am I concerned? Yes, I am concerned. Keith has much more expertise as far as the markets themselves are concerned. I'm more the trading aspect of it and what makes it operate. But the exchanges and the SEC need more rules to be able to show exactly what the markets are.
They're not even implementing the rules they have on the books.
Correct.
They can use the futures markets, emulate those. Those are functioning better.
Sandra, they say they need more people. They need more resources.
Well, it depends on who you talk to.
They need people.
Build a wall? Is that what you said? Build a wall.
No, they need people that understand trading from the bottom up.
That I agree with.
I've been to the high-frequency trading rooms, and they have a great computer system. Unbelievable. They hit a button. All their bids and offers are out.
You can't blame HFT.
HFTs are the ones who benefited from this crash, not the individual investor.
Thank you so much for joining us this morning. Mike Dritz is joining us, Dritz Enterprises Chairman and CEO.